Hey everybody, welcome back to Dividend Stockpile. So today we're going to be talking about NEOS's brand new ETF that they're just launching today, the NEOS Gold High Income ETF, ticker IAUI. Alright, so you guys know that I'm a big fan of NEOS Investments. They have a lot of great products out there, and they've just released a brand new one today. And I've been talked about this particular ETF on some of my other discussions with Troy over at NEOS Investments, but now they're just launching it, so we have a little bit more detail. So I was going to go ahead and give you a first look into this brand new gold high income ETF. All right, so we're on the NEOS website, and as you can see, it's highlighted here. Let's scroll down to get a little bit of information. As I said, it just launched today, so we don't have a ton of information, but what we do know is, like all the other NEOS products, they're going to be distributing their distributions monthly, and the expense ratio is 0.78%. So it's kind of in the middle between some of their other ETFs, which we'll talk about in a second. But given the fact that it's an actively managed strategy, 0.78 is a good expense ratio. All right, scrolling down a little bit more, I'll move myself out of the way. It says the benefits of the IAUI strategy. So it aims to offer monthly income through a data-driven call option strategy on gold ETPs. The fund seeks to offer appreciation based on exposure to physical gold, and then it offers an accessible way to pair your gold exposure with a high monthly income within a single ETF. Okay, so the investment objective is to generate high monthly income with a potential for capital appreciation based on exposure to exchange-traded products that have direct exposure to gold. We're going to talk about the specific holdings in just a second, but I wanted to kind of go through some of the details about the fund first. Okay, so again, it's going to launch today, June 5th. We talked about the expense ratio at 0.78%. And if you scroll down all the way to the bottom of their website, it talks about where this might fit into your portfolio. So it says, may serve as an alternative or complement to existing gold allocations. Now, you're probably wondering why we're talking about gold on a dividend investing channel. Well, because a product like NEOS allows you to get the monthly income while still having exposure to gold, I thought it was a good fit for the channel. A lot of people are interested in gold lately based on the political disarray and the high debt levels of the United States and around the world. They're looking to get exposure to gold. And so if you want to get exposure to gold, but you're a dividend investor, this gives you a good option because it does give you access to gold ETPs, which give you exposure to gold itself, but then it also provides that monthly income while you're holding it. And I think that's the best of both worlds. Again, it's brand new, so we don't have any performance. We don't have any distribution amounts, which I'll estimate a little bit later, but it will be on the same cycle as all the rest of their ETFs. So about third week of the month usually is when they have their declaration, and then the payments usually towards the end of the month. But this, again, is going to be a monthly distribution. All right, so let's talk about the top holdings for a second. So as you see here, the holdings as of right now are primarily T-bills, and the reason for that is they use that as collateral to do their options contracts, and they have about 74% on a 3-month T-bill. Now the T-bills are getting about 4.25% yield on that, so this fund will get to take advantage of that while they're holding the money there. And then for their actual exposure to gold, they do have a ETF, IAUI, which is the Goldman Sachs Physical Gold ETF, which we'll take a look at in a second. And then you can see some of the options contracts that they have out there right now. Because not everyone's familiar with how the options contracts work, I'm going to go into the details of those in a little bit. Okay, so looking at NEOS overall, you know that they have a ton of different options, and this is just another ETF to fit into their suite of products that might fit your needs. So if you look at their website, they have things like SPYI and QQQI that we're probably all familiar with at this point. They have an IWMI, which is small caps. They have some hedge products on the Qs and the SPY. Then they have their Bitcoin, real estate, and now their gold high income ETFs. And then they have some bond and cash equivalent holdings. So they really are diversifying the different products that they offer, and there's really something for everyone. And based on your risk tolerance and your exposure level, the yield will vary depending on which one you get. As you can see, some of the fixed income or T-bill type of strategies get you in that 5 to 6 to 7% range. And then when you go up to the alternatives, you're looking at much higher amounts. The real estate one's almost at 12, Bitcoin's at 30, and gold, we'll find out. And then you go up to the hedge products, which give you a little bit of downside protection. They're in the 8s and 9s. And then you have your high incomes that are looking at 12 to 15%. So in my opinion, this gold one is probably going to be somewhere in the middle, somewhere between these hedge products and the high income ETFs on the Qs and the SPY. So my initial guess, and this is strictly a guess, I have no clue, is probably around that 10 to 12% is where I would estimate this comes in on an annual basis. But once we get the first distribution, we'll know for sure what the expectations are. Okay, so let's look through the prospectus and figure out exactly how these funds generate their income. Okay, so for the options contracts, as you see here, there's two parts of the strategy. First is getting synthetic exposure to gold. And then the way they do that is they buy a call option and they sell a put option at the same amount on the same strike price on the same date. This gives them the equivalent exposure to gold itself. And then once they have that exposure to gold, then they sell call options on the gold exchange traded products to generate the income. And that allows them to be providing the monthly income that we're all expecting while still having the exposure to the upside and the downside of gold itself. Okay. So let's look at those again. So we said that we have a synthetic exposure to gold, and the way that they do that is they buy a call option and they sell a put option at the same strike on the same date. So if you look at their holdings, we have a call at $311 on GLD, which is the underlying ETF that they're doing the call options on, and expires on July 18th. So typically NEOS does about a 45-day contract, and then they'll roll it over as needed. So this is the initial call. This is what gives them exposure to the gold itself. And then, as I mentioned, they write a put for the same dollar amount on the same strike price. So 311 put on 718. So this gives them both the exposure to the upside and the downside of gold itself. So in addition to that, they do call options on gold itself. So you can see here that they wrote another call on GLD, and when you write a call, you're selling the call, so the buyer pays you, and that's how they generate the monthly income. So they did a call on July 18th for GLD at a strike price of $324. And then they also did another strike on the same expiration date for $318. Well, to know if that's going to have a likely be exercised or not, you have to see what GLD is doing. So if you go over to Google, GLD is about $3.10.90 right now. And so that gives you a kind of an idea of how much upside they're leaving on these call options. So again, this is about a 45-day out call. So they're expecting or hoping that the strike price of GLD or the stock price of GLD does not go higher than 318 and 324 is what they're expecting. If it does, then technically you're capping your upside and you don't get any of the additional, but that's one of the risks you have when writing call options. Okay, so in addition to having that strategy, I wanted to talk about how the tax efficiency works. Now, the way that NEOS sets up a lot of their products is they do just classify them as index options on their calls and their puts, so they get to take advantage of the Section 1256 contracts, which, according to the IRS, it gives you a lower tax rate, 60% long-term gains, and 40% short-term gains. And they're also going to be utilizing tax loss harvesting. So if the options contract loses money for the month, they can have that offset the other gains in the portfolio, which hopefully at the end of the year will give us a better tax treatment. Okay, so there's the first look at the NEOS Gold ETF. Again, it's IAUI, the NEOS Gold High Income ETF. Again, it launches today, and so we'll have to see how it trades, and we'll have to see in about a couple weeks, about 3 weeks before the first distribution is announced, to see what the final payout is going to be. But overall, this is another great product from NEOS. I'm sure that it's going to do extremely well, just like their other products have. They provide that high monthly income, as I mentioned, 10 to 12% a year, paid monthly, and that's really based on the call options contracts that they're able to generate on the GLD. So time will tell, but I wanted to bring this to you as soon as I heard it, so that you guys can take a look, put it on your watch list, or even make a purchase starting today after the market opens. Hopefully you enjoyed that breakdown. Hopefully we'll be able to get some more information. I'll do a follow-up video once we get more details on the distribution. Until then, just remember, keep stockpiling those dividends. Bye all.